Hello and welcome to our May, yes it's May Day, our May Switzer Report webinar. I'm Paul Rickard. Joining me today, of course, is the one and only Peter Switzer. Welcome,
on
Peter.
May Day, Workers' Day.
We should be on holidays, right?
We all should be wearing red.
We should be wearing red and you aren't, and I'm sort of a bit pinkish, but anyhow. And of course, our great to have Julia Lee from Burman Invest. You'll know Julia from who used to be with Bell Direct, now got her own business, a fund manager. You are the CEO, Chief Investment Officer, Chief Bottle Washer, everything else.
Many hats at the moment, Paul. Great to be here.
You've got the right support behind you.
Like all startups.
Yeah, like all startups. Anyhow, doing fabulously well already, and great to have you here today, Julia. So just before we get into your questions, just a couple of important housekeeping and I guess compliance issues. First of all, just the obligatory disclaimer, which says that we don't know anything about your personal situation or particular investment objectives. So anything we're going to say today is what we describe as brilliant financial education, but whether it's right for you, we can't say. And of course, before acting on it, we always encourage you to seek the appropriate professional advice. And then just for some housekeeping matters, this is about the level of the audio that you're going to hear. It's an interactive webinar. We've got lots of questions already to get through, but if you want to ask questions, then by all means do so. There should be a question part on the bottom of your screen. If you do want to ask the question, and you can unmute yourself, or we can unmute you and you can actually ask us, but you'll need to give us the signal, put the hand up or raise the hand signal to say that you can do that. But we've got a lot of questions to get to already. So without any further ado, as I always want to do, just start just a quick recap on the last month. Julia, I think I've got March up there. It should be April. That's my mistake on the slide. But 8.8% up in the month. That's close to a record, isn't it?
I think it's the highest monthly performance we've seen for the market in 32 years. So a phenomenal performance for the Aussie share market. But you have to remember that market's still down about 20% for the year. So it is a bounce back from those lows that we saw in March. So April was a strong performance, but still down 20% for the year for the market.
Yeah, I think the other highlight there, Peter, is a bit of the underperformance at the top end of the market. So the big bank, the ASX 20 only up 5.8% at 15.4% down year to date. I guess that's the banks. The mid-cap 50, which are stocks numbers 51 to 100, they really reversed a lot of the losses in March and had a 16% jump in March. So in April, I should say. So year to date, they're all about the same. Yeah. The big caps are still marginally better than the small caps, but a lot of what the damage we saw in March was actually reversed in April.
Yeah, and when you think about it, the banks have been recruited to basically rescue the economy along with the government and the Reserve Bank. And that's part of the reason why we've seen dividends cut as well. So the bank share price has found it very difficult to gallop away after the fall of the crash, while the mid caps, there are companies in there like, for example, Flight Centre would be in there. It was completely smashed. There'd be people who just speculating on the next 1 or 2 years that it'll come good. Lots of those companies were belted up in the crash. It makes sense that they've come back. It's also interesting. I think the small ones actually surprised me a fair bit, Paul.
Yeah, I'm actually surprised by this. They were badly touched in month of March. I'm a bit surprised at some of the recovery there. So it's just the recovery's been a little more broad stream, but I think it is a function of...
well, we were supporters of recovery, so I'm really happy to see green on the screen.
Actually, some stocks didn't move. I mean, some of the major big names actually went backwards a little bit. Telstra, didn't do anything in the month.
No.
The big banks basically held still. Some of the big property trusts, some recovered, some didn't. Yeah. So...
and the miners kind of stay where they were.
The miners sort of, did a little bit, So it's interesting where they did. I think the sectors are really interesting. No surprise about energy, I guess. Although the oil price, I think, technically today is still lower than it was at the end of April. At the end of April, it's lower than where it was at the end of March, but up 24.9%. The other sort of standout there was back into both consumer discretionary and IT. IT leading with 22.5%. So that's the Afterpays, Appens, WiseTechs, Zeros, all those sort of company. Yeah. And then you sort of had an underperformance in a relative sense from sort of utilities and particularly the financials. So year to date, CSL actually didn't move in the latter part of the month, but healthcare is the only sector in green year to date, and that's still largely a function of CSL. Julia, any takes for you on that data?
I think it's good to remember that it was a pretty amazing month, and in amongst all the volatility we've seen in 2020, we still saw some stocks hitting all-time record highs, which I think is pretty amazing. So A2 Milk came out with a pretty positive update during the month, and we also saw some of the gold miners hitting highs as well. So I guess with the volatility, gold's been a bit of a safe haven, especially with governments around the world and central banks adding stimulus to economies.
And I guess the IT sector partly follows the lead from the US, where we did have companies like Amazon hit a record high until its result last night. But we've seen a very strong Microsoft and some of the other major companies. Yeah. So I guess we've sort of followed a little bit sort of catch up there.
Absolutely. I mean, you look at the Aussie share market and you think 8.8% is a fantastic performance for the month. But then you look to the US stock market, and we've seen the S&P 500 up 13% for the month, and the NASDAQ gaining 15.5% for the month. So that really explains why the US has outperformed Australia, because the US is tech heavy, whereas we're bank heavy, and banks really underperformed during the month. And that also explains why the NASDAQ outperformed a lot of the other major indices over in the US. So it was definitely a great month for the FANG stocks and the tech stocks, not only over in the US, but over here. But not so great for the banks. The US banks had their earnings season, and we saw quite a bit of provisioning because of the pain that's expected to come.
And we've given back half of that gain today. So you get on one hand and take on the other. Anyhow, you wonder whether yesterday's performance might have been a vendor month sort of pushing. So I think got to just, and why it sold off so hard today a little bit. Okay, let's just, we talked about the large and mid caps that we'll cover first, Julie. We've probably, I guess, had some of the recovery. So this is, when we put this frame just a couple of weeks ago, perhaps we weren't quite expecting to see the market just where it is today, but just let me just throw that one open to you. What are your thoughts there?
I think we have seen the higher beta names recovering and jumping up the fastest. So just
explain what you mean by beta names, just for
So beta is just something that measures how much a stock moves against the market, and higher beta names, so more than one's usually the market, means that it moves more than the market. So when the market's falling, those high beta names fall more than the market, and when the market's rising, they rise more than the market. So that's one thing to consider, and the smaller caps do tend to be higher beta, with the larger caps tending to be lower beta. But also keep in mind the capital raisings that we saw for the month, which had a massive impact. So the fact that some of the solvency issues disappeared for those companies raising capital meant that we saw a big bounce. And some of those companies were companies like Media, which was up 41% for the month. Afterpay also saw a strong bounce back after its update. And we even saw things like corporate travel up by 33% for the month. I suspect that towards the end of the month, we probably saw a bit of a short covering as well, given the bounce that we saw in the market, which would have been a bit painful for short sellers. And short sellers basically try to make money when the market is falling. So they sell first and then they buy back later, hopefully at a cheaper price. But as the market's rising, it becomes more painful to hold on to those positions. And usually they need to buy back to close out the positions. And a whole lot of short selling buying or buyers drive up the price. So sometimes you see some of those heavy short sold names being driven up when you do see a lot of short covering, because those short sellers are buying in order to close out positions, and buyers usually drive up the price.
Let's pontificate that this recovery is going to continue. Maybe has to have it go down first a little bit, but I think Charlie Aiken is one who's been writing in our report about the weight of cash and the bearish sentiment still in the US, and despite the market keep on going up and fund managers have never been more cashed up. I think our markets had a lot of capital raisings to digest. If you so let's pontificate if the recovery continues. Where do you think the best value still is in the market for the recovery?
Look, in this type of market, I think rather than buying in particular sectors or looking at particular areas, it really is stock selection. It comes down to timing making a massive difference in terms of performance. You only have to look at NAB, which managed to strengthen its balance sheet. Now it was trading at just over $15 before that institutional capital raising. The capital raising was at $14.15. And a couple of days afterwards, you were seeing it trading higher than $16. Now it is trading ex-dividend today, so you are seeing the shares coming under pressure as well as the fall in the banks, but it's still holding around that $16 level. So if you had bought straight after the capital raising, you would have seen a pretty nice performance there, probably up just over 10%, and you would have collected that 30-cent dividend as well. On the other hand, if you had bought NAB last year, then you'd be in a world of pain at the moment.
Yes, and a lot of our questions were around NAB. One thing I'd throw in, Paul, an interesting fact from that US research company, Bespoke. They've said that just about every time, except for the Great Depression, when the US stock market has rebounded more than half of its crash, we don't see a leg down worse than the first crash. Mm-hmm. So it's been one of the arguments that I've been putting forward, that I thought the worst of the crash was over, though we could see another leg down. And it looks like history actually supports that one. And I think given the fantastic news on the virus, as well as the likelihood that we'll escape containment faster than we thought, I think this is all helping to avoid a crash down to the level when there was no support from governments, there was no support from a Reserve Bank, and the uncertainty factor was at a maximum.
Okay. Do you want to add any other, just before we move on, Julia, stocks that you're particularly interested in at the moment?
I think just a comment on the bounce back that we're seeing at the moment, which is pretty amazing if you view it down the lens of earnings expectations this year as well as next year. We're seeing earnings expectations being cut and yet the market rallying quite hard. And that's quite unusual to see that divergence. I think it's important for investors to realize what happens when you see, I guess, a lot of money coming into the market through the Federal Reserve, the government, central banks, basically stimulating. And all around the world, this is happening. So it accounts to about 10 to 12% generally of GDP. Here in Australia, it's been a bit higher at just over 16%. But that money tends to support in the short term. The big question is, are the governments going to, around the globe, going to continue that support and keep ramping up that support? Or at some point, do we see earnings dominating the movement of the market? So it's this real balance between stimulus versus earnings. At the moment, we're seeing stimulus winning out, but over the long term, you'd expect to see some inflection point towards earnings expectations. The other comment is, market recoveries typically don't happen that quickly when you see the amount of damage that's being done to the employment markets. I mean, to give you an idea, the global financial crisis peaked in November 2007. The market didn't bottom out till March 2009. Even if we have a look at the tech rec over in the US, Australia was pretty unscathed. But, the market pretty much had the tech wreck in 2000, and the market didn't really bottom out till 2003. So I guess sometimes, even though we see these sharp rallies, there can be a bit of time to work through some of the economic damage that's done. So one's the health crisis, and we're working towards some of those measures, but the other part is the economic damage and how quickly we can bounce back from that.
Yeah, it's a good point, I think, and technically, if you look at terms like corrections and bear markets and bull markets, the US market's back in bull market territory again.
Yeah,
so
exactly.
It's just interesting it is a function of one of the functions you say, Julie, is just so much cash around, and that's the research that Charlie was talking about. Fund managers have never been more cashed up.
Yeah.
In Australia, they've had a bit more to do their cash with in terms of capital raisings, but that's certainly the case.
And one last thing to throw in is that, Julia made the point that if you look at future earnings, it just doesn't justify this kind of recovery. But Julia, we know future earnings is based on their best guess. And this world is so hard to guess at the moment because of A, the pandemic, and B, the level of stimulation and what central banks are prepared to do. It's probably the hardest ever to believe in any future predictions on earnings, either on the high side or the low side at the moment.
It's really hard to be investing in the market when you see distortions happening because, you know, government's pumping in money and central bank action as well. So look, there are distortions, and it's important, I think, to remember that it's also a US election year, and I don't think President Trump would be wanting to go to the polls through a recession. So no doubt he's going to be trying to support the US economy as much as possible until that election at least is over. So look, there's just a question of whether we're deferring some of that pain down the road. And I guess that's a key question for the banks as well, with some of those mortgage deferrals, whether that pain's just being deferred for an extra 6 months, and whether things are looking up or things aren't looking so great in 6 months' time.
Okay, that's a good segue into the banks. Lots of questions on banks, so we'll rush through these fairly quickly. Is it a good time to buy ANZ, NAB and Westpac, Julia?
Well, I have been buying the banks. Actually, I bought NAB just after the capital raising. NAB's basically gone from being the weakest in terms of its capital position to sort of being middle of the pack. So Commonwealth Bank's first, and then you've got ANZ as well as, you've got Westpac as well as NAB, and then you've got ANZ. So look, in terms of capital positions, NAB's moved up the ranks, and I think that's good news for the short term. Also, it's cut its dividend, so at least it's paying a dividend. But I guess the bad news in terms of NAB is that it hasn't been as pessimistic when it comes to provisioning as we have seen from Westpac. So there could be some more provisioning down the road. But look, I don't expect bank earnings to get back to pre-COVID-19 levels to around about 2022 to 2023. So look, although the dividend's probably going to rise from the payments that we see this year, next year, I don't actually expect it to get back to the levels that we saw last year until about 2023.
Okay, so you've sort of answered those three questions in one go, but anyhow, Peter, just to comment on that?
Yeah, I think she's largely right. It's going to hinge on how fast the economy rebounds. If it comes back faster than we expected, well, then the bank's calculation of how bad this is all going to be for them will be exaggerated, and therefore we might see a rebound in the dividend, not to the level where it was, but we did see it in the GFC. I think, I know CBA, for example, only cut its dividend once, and then when it reinstated the dividend, it was actually higher than it was in 2008. So it's just going to be the growth of the economy is going to be the ultimate factor on what happens to the bank share price and the dividend.
Okay, will Westpac declare a dividend on Monday, Julia?
Probably not, given that, you know, ANZ sort of set the record. So I guess it's one or the either. Either it pays a dividend and it sort of underwrites that, so there's a bit of a dilution, or it does a bit of a capital raising as we saw with NAB, or it doesn't pay its dividend. It defers that dividend like we saw with ANZ and like we saw with Westpac, and then I guess they make a decision about that dividend later on down the track. I mean, just to give you a bit of context in how extraordinary it is to see a bank basically not paying an interim dividend or deferring that decision. We've never seen the banks not really paying a dividend. Usually they're consistent dividend payers, even throughout the global financial crisis, even a reduced dividend. So that tells you how volatile the business environment and the residential property environment is at the moment, and the uncertainty that's involved there. And to see the banks basically giving 6-month mortgage holidays, I've never seen it in my lifetime.
Well, I was going to say that when they're deferring loan repayments, that's when they want to defer dividends, Julia, that's for sure.
Yeah, I think Westpac might just have a small dividend on Monday, but we'll see. Of those three, I prefer Westpac. The market doesn't like it. Still out of love, but I think Westpac's got more
Do you
upside.
think ANZ could eventually pay this deferred dividend if the economy's stronger than expected?
Well, the bank's got absolutely no. We've got to remember that there's no write-offs yet, right? These are just provisions. Nobody has gone bankrupt yet as of the 31st of March, causing the banks to lose money, right? These are just scenarios saying how bad could it be, right?
That's what I was thinking.
And so you got to take that at the first point. Will they come back to it in August? They've said they will. The easiest decision is going to be not to. I don't know. Look, I think it was a fairly gutless decision from ANZ yesterday. That's my view. But we've seen that,
and just about everyone listening to this program would agree.
Yeah, I think there's a bit of pain to be. I think NAB probably did the right thing. It shared the pain a little bit, and let's see what Westpac does on Monday. I guess now that ANZ's deferred, it makes it easier for Westpac to defer, but. They've got a new chairman, and he seems to be running this show. And I'm not sure quite how to read McFarlane just yet as a very hands-on, by the look of it, chairman at Westpac. So that we'll find that question out on Monday morning. I want to just move on to these bank questions quickly. I think virtual banks for disruption. I think the COVID crisis doesn't hasten. In fact, it takes the trend away. Yeah. NAB share purchase plan at $14.15 a great deal, absolutely. NAB shares are currently about $15.80. That won't necessarily be the final price. It'll be the lesser of $14.15 and the 2% discount to where it trades in the week leading up to the share purchase plan. So there are a couple of ways you can play that. If you don't want to have NAB shares, you can sell in advance sell into the shares in the market, buy back in the share purchase plan, take a risk on how many you get, or just wait to that last week and see where it's at and then decide what to do. And then finally, a question from Alice. You sort of touched on this earlier, Julia, about dividends being 1/3. What do you think the recovery path on dividends looks like?
For bank dividends?
Yeah.
I think we'll see them more than double from this year's levels next year, and then probably once again a significant jump. And then by about 2023, I think we will see it back at pre-COVID levels. So for NAB, that means back at $1.60 for the full year. But this year will probably be more around the 60-cent mark. Next year, probably about $1.30, $1.50, and then back to previous levels.
Okay. All right. We think we've probably answered the Westpac question. We'll find that out on Monday. And just Macquarie Bank, we get a lot of questions about Macquarie. How do you rate Macquarie if you had to choice between putting $1,000 into NAB or Westpac or $1,000 into Macquarie? How would you rate those two at the moment?
I mean, I prefer Macquarie for a longer term investment. And if you had gotten into Macquarie a bit earlier, given that it doesn't have that exposure to the mortgage market that the big four banks do. And in fact, the volatility would help some of its divisions as well. Not only that, a lot of its revenue comes from offshore, which means that lower Aussie dollar that we've seen in 2020 would be working in its favour. So look, Macquarie, I think, is a bit of a different beast. It's also been able to adapt to environments quite quickly as well. We saw that during the global financial crisis, where the company saw rapid change and managed to adapt out of that crisis. When we did see the Babcock and Browns of the world sort of going bust and disappearing. So look, I like Macquarie for the longer term portfolio. I think whether it's the big four banks or Macquarie, if you time it right, then either can be good longer term investments. But obviously Macquarie is trading on a premium compared to the big four banks because it doesn't have exposure to that residential loan book. So would
you buy Macquarie not right now, Peter?
We have bought Macquarie around 95, and I like Macquarie, but I make the point, because I think my target price on Macquarie is around $117. But I've got to always remind people that it's only 40% franked. So if you are chasing Macquarie for its dividend, you've got to remember that the other banks are 100%, and I think there's a fair bit of upside for these banks if the economic growth profile over the next year or two is stronger than a lot of economists are predicting. And there are a few outliers like Chris Choi who think that the growth outlook is better than expected.
Okay, all right. I think we've done banks, so I'm going to take banks as done. And if you're sending any other questions as banks, I think we've already done those, so I won't come to them. Okay, let's talk about capital raisings. Yes, the bad news for the first question, Josh, if you want to take part in any of these capital raisings, you do need to be a shareholder at the time they are announced, all right? So if you're not a current shareholder, that's just tough luck. You won't get into them. The second question there from Peter, what's the terms of share price and profitability of companies undertaking capital raising? Julie, do you want to comment on your sense on, I don't think there's anything about share price, but certainly about profitability and balance sheet. Do you want to just talk about why companies have been doing these raisings?
Sure. I think there's been a number of different reasons why these capital raisings have occurred. One is basically for working capital and to cover fixed costs at a time when the business is shut down. So that's probably applies to retailers, the travel companies, airlines, airports. They're doing these capital raisings so they can at least see out the next 12 months. And then on the other side, there are companies doing capital raisings because they want to build a bit of a war chest during this environment where asset prices are relatively low. And those companies that are building a war chest or reinvesting or growing during this time, they tend to perform a lot better in terms of share price action. So they're companies like NextDC just did a capital raising in order to grow. And we also saw Newcrest Mining just recently doing a capital raising in order to look at acquisitions as well. So look, that tends to be well received in this type of environment. And of course, if companies do have the balance sheet and the ability to make acquisitions in what's probably the low of the cycle, well, that really sets that company up for the next 10 years. So companies I'm watching very closely there, Woodside Petroleum and Wesfarmers, which have strong capabilities to make acquisitions at what's probably the low point in the cycle over the next 10 years.
Okay, so questions about QBE and Bapcor. So QBE, Bapcor's share purchase plan is at $4.40. It's currently trading around $4.75. QBE's actually gone below that. It's currently below its issue price of $8.01. What are your thoughts on those two companies?
Look, I think when you're looking at the share purchase plan, you kind of have to evaluate the share price when you're applying for those shares. And as you said, Paul, if you don't want the full allocation, you can always sell on market if it's a higher price than that share purchase plan price, and then acquire those shares. So hopefully you've got a lower entry price. Of course, people's tax situation and how long they've held those shares are probably going to come into the equation on evaluating that decision as well. I actually bought QBE on market. I think the market's being overly pessimistic around its outlook. We didn't even see QBE's share price fall down to these levels in the global financial crisis. There are probably going to be less returns coming through from QBE, but essentially, it's something that we need. It's in the area of insurance. So I think the 3 to 4 year outlook for QBE is looking pretty attractive here, and I think it has been oversold in the market that we are. So QBE has come out to say that it is expecting to see lower growth, also that it's de-risking its portfolio, so getting out of equities into, I guess, safer type of investments, which is going to mean less investment returns over the
What about, I'm not really quite sure why the market's taken such a negative view on insurance, and IAG's a little bit in the same category, but it has. What about Bapcor, which of course is the car parts sort of retailer and supplier to the trade industry through things like Burston and other brand names? What's your thoughts on Bapcor?
Yeah, I think Bapcor is a good quality company that's been driven down to quite low levels. So once again, the actual decision is going to depend on where the share price is trading at the time of the share purchase plan. And if you don't want to be diluted, you can sell on market at a higher price than the share purchase plan if you don't want to take that risk. But generally with these share purchase plans, I evaluate them on the basis of price because you're already holding the share. So unless you're thinking about selling the whole parcel of shares and you don't want to be a shareholder anymore, you've already made the decision to be involved in that company and the company's outlook. So really, to me, these share purchase plans, the retail ones, comes down to price.
Yep, and bear in mind, almost every one of these plans, and there's been 21 of the ASX 200 companies have now done a capital raising with the share, with like something like this. The price is actually, you've got a fair bit degree of protection on the price for the last week. So you don't actually need to make a decision for the last week. You just pay by BPay. There's really no urgency apart from a cash point of view to make a decision until really the last day or two.
Yeah, I think Josh is it Josh? No, it's Chris or Michael that QBE has been a great wealth destroyer. The analysts believe there's 38% upside, so even if they're half right, maybe there's a reason to think about QBE. I hold QBE, but I don't like the company. And Bapcor, I do like it. I think it's a good company, and I don't hold any shares in it, but I would if I would take up the purchase plan if I was holding Babcock.
Okay, InvoCare. I just didn't. InvoCare, the price in InvoCare is at $10.65. What do you think about InvoCare, Julia?
Look, InvoCare right now is doing it pretty tough because the death rate despite COVID-19 is probably going to be relatively low. We're all social distancing and washing our hands, so that means we're probably not getting some of the other things that we usually catch around this time of year. So look, the death rate is probably going to be low in 2020. It's a pretty morbid company because it looks at funerals. Also, there's a restriction in terms of the size of funerals at the moment, which means the cost of people spend on funerals is decreasing. However, you know, these are not conditions that are going to last forever. And I think one of the things that people have to evaluate when they're investing in an environment like this is, are those conditions going to be around forever, or are things going to get better? And if things are going to normalize for a company like InvoCare, then the type of prices that we're looking at are pretty attractive for the long term. And that's because InvoCare tends to have pretty defensive cash flows to the market. The things that I'd be worried for a company like InvoCare is if we do see disruption to this area and we see a cheaper cost operator coming in and getting scale. So competition's probably one of the things that I'm watching very closely in the funeral space. But in terms of its traditional cash flows and dividends, they've been pretty stable and defensive type of cash flows.
Okay, look, I could get quite passionate about how retail investors have been forgotten in the recent round of discounted and underwritten institutional issues. The answer is absolutely. Some of the companies have been done a terrible disservice to their retail investors, but we might move on, Kerry, unless anyone wants to comment on that. We'll keep going to your questions. Do you think there are any more major companies that are, I'm not sure there are a lot of companies in the top 50 that are so indebted that capital raising is probably certain to keep them liquid? That's a question from Wendy. Julia, what's your response to that?
Well, I think we understand where the most pain is being felt at the moment. That's in the travel, the retail sectors that have closed down, as well as it's quite interesting looking at things like toll roads, which have managed to bounce back quite quickly as well. So look, I think we will see more capital raising, and that's as the earnings outlook becomes clearer for these businesses. It's a pretty clear line at the moment which businesses are doing well and which aren't in this COVID-19 period. And I suspect that this July confession season, which comes before the August full year earnings season, is going to be an extremely busy one where we see companies getting...
Do you want to name any that you think you'd be expecting a capital raising?
In the large cap space?
Yeah.
I think it's quite possible that we could see other banks. The other place that I'd be watching very carefully is the energy sector, given the volatility that we've seen in the energy space. And we've also already seen a couple coming to the market there. And then the other area I'd probably be watching are those real estate investment trusts, especially those areas with high exposure to shopping centres. And we've seen some of those come through, but I suspect we might see a little bit more from the real estate investment trust area, given the mortgage holidays, and we might even see that creeping into some of the other commercial type of areas as well.
Okay, I might keep going. Peter, for you, the politicians are stuffing up. Cannot see, these are more general comments. Cannot see recovery in markets till pre-Xmas 2021. Well, we've already had a big recovery. Your thoughts?
No, Gavin, I think you're wrong, mate. I do believe that this market, I've always said there could be another leg down, but it won't be as bad as the first one. I don't think the politicians are stuffing up. I think the politicians have done an extraordinary job. And the Brookings Institute in the US actually nominated Australia, New Zealand and South Korea as the best at both the coronavirus policy and as well as their economic stimulation policy. So I think we're going to do okay. And Gavin, I think that's probably a very negative point of view.
Let's go to the RBA printing money, which of course it's doing by buying bonds effectively. Does this devalue our current cash holdings?
Well, yeah, of course it does. But the reality is our current cash holding as individuals is actually assessed by the currency. And the currency got as low as 54 US cents and it's now 65. This is not an issue I particularly worry about. You know, it's the kind of thing.
Every country in the world's central bank is printing money, so don't think it's unique to Australia. The US Federal Reserve is printing a truckload of money.
Yeah, and the fact that we're doing well is always, I think, reflected in the currency. When we were really scared, the currency hit 54, and now we're looking a lot stronger at 65. I just think that's a reflection of the fact that we are doing better than we expected 6 weeks ago.
We probably could talk about industrial relations, and I think, Bruce, we might leave that just for another day, if that's all right, because we'll get shared the questions there. Okay, just about China, and again,
China, probably the rest of the world. Will they retaliate? Yes, they would. And I know Chris Joy actually said Wuhan could become the Franz Ferdinand of the 21st century. That I don't think it'll happen. Look, sure, Trump is a guy who could really push it more than most politicians. But I even noticed that Greg Hunt, health minister, backed away from blaming the wet markets during the week, which I think politicians will be very careful about using China to really, bring the global economy down. But, that's my best guess.
Are you worried about China, and particularly our relationship with China as a fund manager, Julia?
I'm not so much a relationship with China. Hopefully it stays on good ground, and that's because China is our largest customer, especially in our areas of key exports of coal, iron ore, even education. So and travel, obviously a big supporter of that as well. So hopefully we won't see a deterioration in our relationship with China and some trade sanctions coming through there, because that would be quite detrimental for the Australian economy as well as the Aussie dollar. I guess what I'm watching with China is that in the first half of the year, or the first quarter of 2020, it was really the supply side of things that came undone and which led to lower growth. Whereas in the second half of the year, I really think that it's going to be the weaker demand side, which means lower growth for China. And usually what we've seen China do in the past is build infrastructure, concentrate on building as well as stimulus. And if it does that, we could see iron ore continue to be well supported.
Okay, let's move on to some stock questions. And I also had some questions about gold, one from you, Jeff. Just firstly, Julia, do you have a view on gold?
Yes, I do hold gold. I've got Evolution as well as Silver Lake. And look, gold prices have been doing very well in 2020 because of its safe haven play, but also as a function of, I guess, some of the stimulus coming out of the US, because gold is traded in US dollar terms as well. So if we see a weakening off in the US currency, then gold's going to be a beneficiary there. And I guess we've sort of seen that with the Aussie dollar as well, moving from 55 to about 65 US cents. So if we continue to see the US currency being diluted, then that would be good news for gold. Gold, though, as a deflation hedge, I don't buy into that story, and that's because inflation hedge, and that's because I think we're facing deflation over the next 8 to 12 months rather than inflation.
Okay, so are you buying gold stocks at the moment, or are you seeing the?
I'm just holding on to my gold stocks. I'm not adding onto those gold positions at the moment, but definitely holding some gold in the portfolio.
Okay, the fund manager everyone wants to own Magellan. Peter, what's your view on Magellan?
I think it's well priced where it is poor. I'd buy it on a dip. If it dipped substantially, I would. We've put our financial planning clients into Magellan and into WCMQ or WQG. Both of those are very good fund managers, but I think Magellan has been chased, and its share price is probably where it should be, but certainly buy on a dip.
Any views on Magellan quickly, Julia?
Yeah, I mean, it's a derivative of the market. So if we continue to see the market pulling back, Magellan's going to pull back more than the market.
So it's going to have a beta of more than one?
Yes, most definitely. Generally, it tends to move about double the market, or most double the market. So if we see a big dip back, that's the time to be buying into Magellan. And, not only could you look at it as potential longer term investment and accumulating, but the volatility in the market and Magellan's share price means that you can make pretty big short term profits in it as well.
What about, we used to be, a lot of people used to love Adelaide Brighton, and it's done it tough the last 12 months. Adelaide Brighton, Julia?
I think Adelaide Brighton, obviously in the construction space, which is coming under a bit of pressure. But I think coming out of this recovery and thinking about how this recovery is going to happen and what's going to bounce back first, I think one of the things that will bounce back last is probably the services area. So things like retail and takeaway stores, they're going to do it a little bit tougher, hospitality, and lag other things like the construction space. So I think construction is going to be one of those areas
Yep.
which is a quick bouncer. So if you're looking for exposure to bouncing back, the other thing with Adelaide Brighton is to watch that share register, because it does have a major shareholder. Let me try and look up how much of the shares they hold. Barrow Properties has over, I think, a 40% stake in the business now, and they've just been creeping up with their provisions. So potentially a merger down the track with that big construction.
Yeah, it would certainly be on the shopping list of a few companies, I would have thought, if Adelaide Brighton stays depressed. So,
and Paul, the thing is I agree with Julia. I think construction will be the bounce back sector in 2021. And because a lot of sites have been slowed down because they can't get stuff from China. So, you know, while they could have kept on going during the coronavirus, they're really been on sort of marking time. I think construction sector will bounce 2021.
I'm less
with house prices, by the way.
I'm less of a bull about construction. I look at the, as you know, Peter, we're here in the city, and all these projects are continuing. But who's going to do new commercial buildings and retail shopping centres for the next going forward for a long time? So, I know the governments are going to pour a lot of money in. They talk about shovel-ready projects, but I just think if I was a builder, on a commercial builder, I'd be very wary to start a new project. So I'm not quite as agreeing with you that construction is going to be a bounce back that people think. But anyhow, that's what makes a market. A lot of questions on Afterpay. Vincent, you've also, not Vincent, Patrick and James and a couple of others have sent in questions about Afterpay. Julia, back near $30. It got to, I think, $8.90, I think, didn't it?
Yeah, I think I traded this one around about 12 when it was looking attractive. At 30, I'm already out. Look, Afterpay at $30, I think the risks are building that, you know, its core client base, which is probably the millennials, they do tend to be more of those casual workers in the retail and the hospitality space. And I just think unemployment's going to be much higher in that age group, in their core demographic. So while retail sales may initially hold up, I think the size of retail sales is just going to shrink over the next 6 months, and that has to have an impact on Afterpay.
Yeah, I'm with you. I think you know, I didn't buy it at $12. I looked at it and thought this looks really attractive, but didn't have the guts.
It was $8.90 on March 23.
But you know, it's now back up just under $30. I think this is now more in sell territory than buy territory. So, and I think there may be some behavioural changes coming as a result of this. So we're sort of on the same ticket there. Xero, now that's almost back to $80, or it was yesterday that it started the year out. I think it's a fantastic stock, so it's almost back towards its, not far off its high. What's your thoughts on Xero, Julia?
Look, I like Xero. I think we will see a number of companies disappearing. So obviously the size of its market's going to disappear. But one thing Xero has done this year is to raise prices, I think by about $5 a month. So that's going to give it a bit of a buffer during this volatility. So it has added some extra services, I think, to that $5 a month fee, including being able to upload invoices through your phone or through your camera on your phone. And as part of that, they've increased the overall fee, which means they're getting more revenue from their client base. So look, I think they're well buffered during this COVID-19 crisis, even though the business sector is going to be hit hard.
Okay, all right, let's keep going here.
By the way, I'd say buy on a dip, but it does not dip much.
Yes.
It does not. It got down to it got down to the sixes, I think.
It did, yeah, the day on March 23, but since then it's hovered around the 78, 79.
Woodside, I reckon Woodside must be one of those stocks that you're talking about, a potential capital raising candidate. What do you think on Woodside, Julia?
Look, I think Woodside has a pretty strong balance sheet. If anything, I think it'd be looking at acquisitions in this environment. So it depends on the size of the acquisitions that it's looking at. But look, it has the ability to defer some of its capital expenditure, which I'd imagine it's looking at doing. So I think Woodside Petroleum's in a pretty good space going into this crisis, despite the oil price being at the levels that we are. seeing. And the time to make acquisitions in that energy space is right now.
You're a bit of a Woodside fan at these levels, Peter?
Yeah, we bought in at, I think it's $17 or $18, so I'm really happy. I got to say, it always struggles in the 30s, but still I think there's upside, and I think the fact that Julia likes it makes me like it as well.
Okay, CSL's it was the star for most of the recovery, but it's sort of, I think the last week or two you've seen people switching out of CSL into things like banks and other stocks. They're not going to sell CSL very far, but is it going to just keep on its upward trajectory, Julia?
Yeah, so I've been trying to think through CSL, and I'm struggling at these levels at the moment because there are a number of risks I see on the horizon. Number one is that I guess people are anticipating that more people are going to be getting flu shots this year because of COVID-19. And I'm not so sure that's the case because of social distancing and people just being at home. So I'm not sure whether we're going to see that spike in flu sales. So that's one of the things. If we do start to see a really big uptake of that flu jab this year, then that would be a positive for CSL. But of course, that doesn't make up a huge amount of its earnings. The bulk of its earnings comes from its blood plasma business. And what it's done really well over the years, it's been ahead of the curve in setting up these blood collection centers. So as we've seen demand spiking, it was collecting a lot more than its competitors. So the key is what's going to happen to blood plasma demand in this type of environment. There's a lot of a bit of controversy at the moment with CSL because it pays its blood donors over in the US, and with the unemployment rate spiking, they might get a bit of a spike in donations as well from people who are looking for some extra income while they don't have jobs. But really, are we going to see the demand for blood plasma being the same as other years, given that we're not seeing as many car accidents, people putting off surgeries because they don't want to go to the hospitals during COVID-19? So I'm unsure of I'm unsure of CSL at these prices. I'd probably be neutral. I'd want to see a dip of 20-30% before I'd be interested in buying this stock in the type of environment we're in. I love CSL, I just don't like the valuation.
Okay, we'll keep moving on. The retail sector, JB Hi-Fi is almost fully recovered back to $34 to $5. You buyer of these stocks and stocks like Lovisa?
When I look at companies, I try and ask myself, are the best times in front of it or behind? Is it, I guess, looking at growth in the future, or is it looking at moderating growth? And for JB Hi-Fi, I think it saw a surge up because people were scrambling to get keyboards and monitors to work from home. But now that surge is over, I guess it's really dependent on the retail spending environment. And with the unemployment rate here in Australia expected to hit double digits despite the stimulus that the government's providing, I'd probably be cautious of some of the higher multiple discretionary retailers out there in the market. So JB Hi-Fi, I love the business, but I think that there will be better opportunities over the next 6 months.
Okay. Appen and Aristocrat Leisure. Aristocrat Leisure has also had a big recovery. Appen as well.
Yeah, I like both of these companies. I think Appen's an interesting one because of artificial intelligence and governments being big spenders in that artificial intelligence area, as well as the militaries. And look, it's one of the very few companies that's come out during this crisis to reconfirm their earnings expectations, which I think is a hugely positive sign for Appen. So I think it's well positioned to get through the COVID-19 storm and the type of environment that we're in. And it's obviously still thriving as well. So look, I like Appen. Aristocrat Leisure, I think, is an interesting one. It depends on, I guess, part of it depends on how long the casinos are closed for, but I think casinos will bounce back. But the other exciting component of their business is the big fish business, or the digital gaming, which has been seeing strong growth from people gambling at home. And look, I think that trend and that move to online gambling, that will continue to grow. So I think Aristocrat Leisure is actually a good one.
Okay, I'm just going to move on. I've got lots of questions here to get through. Coles, buy at these higher levels? I'd probably say no, but what's your view?
Yeah, once again, it's asking yourself, are things going to get even better from here, or are they going to moderate? And the answer is that they're probably going to moderate as people start to go back to work, so they won't be making their lunches from home anymore, so less shopping trips are coming through. So look, it will be a consistent dividend payer through this environment. So if you're looking for income, you are looking for that earnings growth to come through to support that income. And some of the areas that are quite supportive of dividends, obviously not the banks because of the earnings pressure that we are seeing, but consumer staples, obviously the supermarkets, the utility space is another area, as well as telecom.
So Coles is in sort of that resilient type stock. I was a bit surprised the market had taken Coles and Woolworths to the levels they did and hadn't worked out that all these things they're doing, there's got to be a huge extra cost. And having people, check out, have sanitized, clean supermarkets, restock, have special logistics.
But they also had an extraordinary burst of purchasing of toilet paper and stuff like that.
And that ain't going to continue.
Yeah.
So,
but I think this is the bottom line. We're talking about three very good companies, Coles, JB Hi-Fi and CSL. They're a classic buy on the dip, because if they do drop, because there's another leg down, the sort of companies you get a chance to, you wouldn't go for them now, but on a dip, they're the quality companies I would be buying.
Let me just go to some of the questions that come in during the other questions we've got. Quite a few questions about BHP, Rio and Fortescue. Iron ore prices are hanging on. What do you probably not necessarily the stocks that make up your portfolio all the time, but what are your views on those three iron ore majors?
Actually, when I talked about dividend payers, consistent dividend payers, I forgot the material space.
Yep.
Pretty incredible, but they're certainly going to be paying some pretty good dividends this year as well. So look, I struggle to say that material stocks are a dividend stock, but definitely in this environment they are. And look, they're looking very good in this environment. I think the only thing to remember with these material stocks is that we kind of forget that they are cyclical, so they do have their ups and downs. But I think hard commodities generally are an okay place depending on Chinese demand. At the moment, I like Fortescue. It's also come out with an upgraded production forecast in terms of iron ore. It's low cost producer at the moment, but given where oil prices are, the question is whether BHP manages to outperform over the next 3 or 4 years as we start to drive cars again and fly again, and we see a recovery in energy consumption.
Why's the market gone a little bit off Rio the last month? Do you have a view on that?
Not really.
Okay. All right. Well, that's also back to Fortescue. I think James said he's up 70%. Is it time to sell some? Well, you're doing well, James.
Yeah. Rio Tinto, yeah.
Yeah, I'd sell too. But by the way, Paul, I like BHP, not only for the dividend, which you can't count on every year, but the year coming up, yes. And I also think there's probably 10 or 15% upside in BHP if you believe there's going to be an economic recovery. And I do believe that.
Okay. So question here from Vincent about, we'll just try to stick some of the better known companies for the time, Wesfarmers or Woolworths. I mean, they're very different companies. Wesfarmers is now really largely Bunnings
retail,
discretionary retail, but Bunnings stores have been doing super well. So would you have a view between Wesfarmers and Woolworths?
I like Wesfarmers as a growth stock and Woolworths as the income stock. Wesfarmers is cashed up, so it would be looking for an acquisition, I would say, in this environment, and you'd hope it'd make an acquisition given its war chest. So it really depends on whether you back Wesfarmers' ability to be able to create value from a large-scale acquisition. I like Wesfarmers. I think shopping in this type of environment for an acquisition is a good strategy. So I'd go with Wesfarmers, but I tend to be growth orientated. If you're looking for income, obviously Woolworths would be the choice there. Okay.
All right. Just a question on, I'll just keep going with the question. Maybe we can, are there any, just Reece, is that a company that you follow closely, Julia?
So recent
Reece.
Yeah. Yes, they did a capital raising, I think. They did a capital raising not too long ago.
They did, yep.
And I guess once again, it comes down to price. If you manage to get some in that capital raising, Reece is a good quality company, but obviously depends on global demand and demand here in Australia for those type of products. I think Reece is probably still pretty resilient from what I can see. People are still working on their houses in this type of environment. Might not be looking to sell their houses if they don't have to, but certainly looks like people are. We have the hedge indicator in our suburb where we walk around and have a look at how well the hedges are being maintained. And during COVID-19, that indicator's hit a record high.
Yeah. Okay, let me go on to the property trust, particularly the retail property trust. So this relates to the question above about Vicinity and Centre Group, and also a question from Tim, and I guess Cromwell's sort of in that category a little bit too. Do you think the property trusts have taken enough of a beating? The sector was up during April, not all companies. What's your sort of sense on the property trust market?
I definitely think there's opportunities in that property space. Cromwell's, I think, a little bit different because it has a diversified portfolio. Property trusts, which deal in shopping centres in particular, have been indiscriminately sold off. And I can understand it for large property trusts like Unibail Rodero Westfield, where we probably will see either rents being cut substantially over the next few years, but also structural changes where we'll probably see a lot of those big chains cutting down on their retail footprint and trying to migrate more of their sales online. So some of the move that we've seen since COVID-19, I think it's just sped up the structural changes that we're going to continue to see in that space. But on the flip side, I really do like those shopping centres that are more neighbourhood shopping centres that are anchored by supermarkets, because I think we are tending to shop a bit more local and consistently local, whereas when we are looking at some of those discretionary items, that we're much more likely to jump online. So I do prefer those shopping centres, I guess the neighbourhood as well as the regional shopping centres, rather than the big large scale ones like the Unibail.
Okay, Peter, your shopping centres property trust part of your portfolio?
No, they're not, and I think they're too hard to work out. You know, Julia's kind of guessing that we'll become local shoppers again, and she could be right. I just don't understand it, so I just won't invest in it. But while we've got her, we've got to ask her about EML payments, because she mentioned it at our micro cap conference. It shot the lights out. As always, we thought she was a genius. It's struggled lately. Is there a good reason to stick with EML, Julia?
Yeah, I actually wish I had bought some just after the capital raising, because it has rallied quite hard. Look, I can understand why email, and I wish I could have forecast, the COVID-19 crisis back in September, but I had no ideas that we'd be locked down, shut down, and not shopping. And if we have a look at email payments, really it looks like at prepaid cards. So looking at things like gift cards, also when it comes to casinos, when you've made a win, you have a card that you can load up. And then looking at that acquisition it made. In terms of the acquisition in Europe, the good news is that it's managed to buy that at a much more attractive, cheaper price. So that's a positive there. But on the flip side, a lot of retail sales is closed for business at the moment. So we aren't buying the gift cards, and the casinos as well are closed for business. So look, I think that it will bounce back very strongly once, COVID-19 and the shutdowns are lifted, and especially at the levels that we're seeing at the moment. But you're looking at potentially a 3 or 4 year recovery plan.
Okay. All right. Is there any other? I want to just go to some other questions that have come in. I think that we might just leave those ones there. Peter, this is a question here today from another Peter. So he says, so you don't think that today's big sell-off is due to Trump's latest threats of increased tariffs on Chinese exports?
Well, there could be a little bit of that in there, but look, I think that the safest thing to assume is the market went down a lot. We've rebounded a lot. We've still got question marks out there. Therefore, it's likely there'll be another bit of a sell-off of some kind. I think it will be a buying opportunity when the sell-off comes. But we'll get all these strange things from Trump, and then we'll get positives from drug treatments. I just think at this point in time, we've done unbelievably well with the bounce back, particularly America. Australia hasn't done so much because of the banks, but I do believe that we're in a much better position than we were in March 23. I think by the end of the year, we'll be in a much better position again.
Okay. John points out that Bitcoin's halved in the last 10 days. I didn't know that.
No.
Do any panelists actually have Bitcoin and what will happen? Julia, have you invested in Bitcoin?
I'm a stock analyst. No.
I've gotten, sorry, John, we're just out of our depth on
Yeah,
Bitcoin.
sorry,
We find
mate.
stocks hard enough. Okay. Just we're getting close on time here. Just on the question from about Cochlear, because we saw the capital raising, a gift capital raising, but do you have a view from Cochlear, given we're seeing some elective surgeries resuming in China? What about Cochlear for you, Julia?
Yeah, I think Cochlear is a good one for the long-term portfolio. Obviously impacted in terms of hearing implant surgeries, with some of the elective surgeries being on hold in some countries. But look, that's temporary. Once the COVID-19, I guess, passes and the weight and the need on our emergency departments subsides, then we'll see those elective surgeries coming back to the fore. So look, I think some of those essential surgery type of companies, you know, if you can get them at a bargain price, this is the time to do it and pick them up for the next 10 years.
I think they treated retail investors pretty badly.
I think they did indeed. Okay, we might need to wrap it up there because we do like to finish this by 1:30. It's just a fraction minute or two after 1:30. Julia, just finally before we let you go, any stocks you want to make reference of?
And the best one.
The best one. What's your favourite number one buy on your buy list at the moment?
I get this question a lot, and I guess it's because people either are taking steps or getting tapped. But in this type of environment, I think one of the strategies I like is to go very high quality and then very high risk as well. So have like the large cap portion of your portfolio and decide how much that's going to be, whether it's 80% or 70%, and then have the smaller caps, the sort of high beta areas. And that way you get the best out of both worlds. Or if you get confused, just have a look at each sector, the biggest stock in each sector, and then decide which sectors that you like as well. I've been looking at companies straight after they've been doing capital raisings, because I think that once the balance sheet isn't in question and that capital raising a cloud lifts from its share price, it's usually a bit of a low for the company and it's a good buying opportunity. So I have been looking at those companies where the liquidity concerns are disappearing, as well as people being too pessimistic on the stock. You'd have to think that stocks that are related to travel like Webjet are probably at peak pessimism at the moment, and in 6 months' time, are we going to be as pessimistic about Webjet? And if not, the share price will rise substantially, in my view.
And also, she's got the favourite in the Wagga Gold Cup today called Carp Fever. She probably likes that as well.
What time's Carp Fever running?
4:15.
Yeah.
4:15. Okay, thank you very much, Julia. Peter, I think we've got US employment tonight.
Yeah, but
Does anyone care?
I don't care. And the important point is the numbers are irrelevant. They're scary. I want to see them get to their maximum and see how quickly they start improving. That's going to be the most important economic indicator to me. I'm really happy to see that in Australia, consumer confidence has rebounded 3 weeks in a row. And that's because the containment costs, containment being reduced, and the beating of the virus has been very good. And I think there's the same sort of thing. Get to the worst of these numbers, which are ridiculous numbers. You know what? How many is it? Is it 20 million people on jobless claims in America?
I think it's getting close to 30. I think.
Yeah, but when they start dissipating at a rate of knots, that's what I'm going to be looking for.
Well, it could be an interesting night in the US because we had a week close last night. We also had after the bill reports from Amazon and Apple that were a little disappointing, and President Trump making a few noises, and a week lead in from Asia. And last night was the end of the month, and funny things happen at the end of the month. So,
exactly right.
Yeah, we've had particularly when you've rallied into it. So anyhow, maybe it's an interesting night, but you'll be writing about that tomorrow in tomorrow's Saturday Switzer report. Julia Lee, CEO, I'm going to call you of Burman Invest. Thank you for joining us.
Been fun. Thanks for having me.
And to all our regular subscribers, thanks for joining us again. Sorry we ran just a little bit overboard. There are lots of questions we couldn't get to, but I did try to get a sample of most of the questions, and I'm sorry if we didn't get to your question, there just wasn't time, but we have to keep these to 1 hour. We know people like to get away as well. So that's all from the Switzer report for our webinar this month in May. We'll be back. You can always get a download of this on our website if you want to miss any pearls of wisdom from Julie Lee that you didn't pick up during the program. That'll be on our website shortly, and we'll be back at the same time next month. That's all from this webinar. Have a great afternoon, a great weekend. Those of us in New South Wales, we can actually go out this weekend. I think in some other states, Queensland as well. Bit of social, we're allowed to actually go to our friends.
Dinner party for two.
Dinner party for two.
Oh, four.
Four, maybe.
Two strangers can turn up.
Anyhow, let's hope that we all need to keep social distancing. Have a great investing afternoon, and we'll talk to you again shortly. Thanks for joining us. Good afternoon.